Welcome to Forex Fundamentals Pro, where we not only educate you, share trading strategies, we also offer optimized tools to give you a real edge in the market. So let's get started. In this video, we're going to be discussing the Relative Strength Index Indicator, or RSI for short. The Relative Strength Index is a momentum oscillator that measures the speed and change of price movements. It oscillates between levels 0 and 100 and is typically used to identify overbought and oversold conditions in the financial market. On this chart, we have three windows. On window one, we have blue candles that represent bullish candlesticks, meaning price is going up. And we have red candlesticks represent bearish candles, meaning price is going down. On window two, we have the Relative Strength Index Indicator. And the Relative Strength Index Indicator oscillates between the overbought area and the oversold area, which is the level 70 and the level 30. But the extreme levels is 100 and 0. Typically, when the RSI reaches level 70, price is considered to be in the overbought area. When we are at level 30, price or the financial instrument is considered to be in the oversold area. So this is overvalued, and this is where price is considered undervalued. These are the levels where traders look for entries and exits. They are key entries and exit points because price could potentially retrace or reverse. For instance, I'm going to put a vertical line on the chart at this point where price reached level 70. I'm going to identify it with this yellow line. Okay, that's where price reached level 70. And we're going to do that again over here where price reached level 30. And I identify one more area right about here where we reach level 30 as well. And we have one more area approximately right here where price reached level 30 again. Now, if we follow these points, we'll be able to see that price did different things. Here at level 70, if we look at price up here, you see price got to a high and then it actually reversed. Initially, we would consider this a retracement. If price was overall moving up, this would be a retracement, price pulling back and potentially about to push up again. But as you can see, overall price fell. So price got to a high at level 70 on the RSI and then eventually reversed altogether. Now, right here, where we got to a level 30, we can see price getting down at this point, had a little retracement, a little bit of a retracement pullback, and then it continued to go down. So the opposite happened for when price got to the level 70 here. Price got to a high and it reversed completely in the opposite direction. So it was going up, but then it reversed and went completely in the opposite direction, where in this case, price got to its key RSI level, level 30, instead of getting here and completely reversing and going in the opposite direction, it just had a minor pullback and continued to go in the direction for which it was originally going. We see the same thing happening at this level as well. Price got to this low and eventually had a little bit of a retracement, consolidated a little, and then continued to fall in the direction in which it was originally coming from. You know, price was coming down, pulled back a little, and then fell. Same over here, we reached the level 30, in which price was falling. It fell. It didn't even have a retracement at this level. It just fell. And eventually we see price pulling back to some extent. So you can't look at the RSI and say, okay, when we get to an overbought area, that it's time for price to just reverse altogether. And we can't say when we get to an oversold area that it's time for price to reverse altogether. It's possible that that can happen, but we can also verify that sometimes it could be just a little retracement. Sometimes it could be a complete reversal. And we can see that sometimes it could be no reaction at all. So as a trader, you must keep that in mind, that it's not foolproof. It's not guaranteed that when price get to the RSI 70 or the RSI 30, that price is just going to completely reverse. But we're going to share with you today how to leverage the RSI properly when it does get to these key levels, and how we do determine which way we can consider placing a trade. Okay. And we'll also get into what is so special about this third RSI that's on this chart that looks exactly as window number 2. Okay. The third RSI is actually Forex Fundamental Pros RSI divergence to signal alerts indicator, which is an optimized indicator. And we're going to get into that later. Okay, so let's look at how we can leverage the RSI properly. If we look at where we have these vertical yellow lines, we're going to look at those key areas, but we're going to step from one area to the next. What you want to do and consider doing when you are leveraging the RSI at these key levels of RSI overbought area, RSI oversold area, generally the RSI 30 and 70. You're usually typically the RSIs typically use the period 14. So if you right click on the RSI indicator, which is the blue line represents the RSI on this line graph, we can right click on it, go to properties. We'll see we're using a level 14. That's typically the period that is used. Okay. So on this chart, we're on an hourly chart and we're looking at the RSI using the period 14. Okay. Now we're going to start with price. We're going to start with price pushing up and the RSI reaching the level 70. Okay. Now what we can see right here is a candlestick pattern. Okay. Do you know what that candlestick pattern is? It's an engulfing bar, a bearish engulfing bar pattern. What you want to do is when price gets to a key level, and in this case, we're getting into an RSI overbought area. That's step one, get to a key level. The RSI overbought area is a key level. Second step is to wait for a confirmation of some sort of reversal, indicating that price is going to be changing its direction. If you don't have a confirmation, then you do nothing. If you happen to be in the trade beforehand, you do nothing. You can remain in that trade until you get, a signal that price is going to consider changing direction and going the opposite direction. So you're either in the trade already or you're waiting for a signal to get into the trade. Okay. So again, step one, get to a key level. In this case, it's an RSI overbought level. Step two, wait for a signal for a reversal. In this case, we are seeing an bearish engulfing bar pattern. Okay. Next, what you want to do, depending on if you're a conservative trader or if you're an aggressive trader, which you'll learn in time what type of trader you are. If you are a conservative trader, what you want to see happen is you want to see price break its structure. So price was pushing up. And what you want to see is you want to see a representation of price breaking its structure. So let's try to identify what I mean here. Okay, so in this case, I'm drawing these lines on the chart, it's aqua lines. So we have price going up, coming down, and going up and coming down. So essentially, we have price going up, coming down, going up, coming down. And we have price going to a high, pulling down to a low, going to a higher high, pulling down to a higher low. Okay. Now from there, we expect for price to go higher if it's going to continue in an upward structure. But if we come to a scenario where we have price pull up, let's say that's where we're at right now, and then we have price, what I would say, breaking structure, that would be here, where this was a low. And price went below the low, closed below the low. So if this was the low, over here, price went below and closed below the low. It broke this upward structure. So you want to see price breaking structure. If you're a conservative trader, you want to see price breaking structure after it reached a key level, reversed. You want to see a breaking structure, pulling back to test that level, which was originally support, either testing it as resistance, pushing away, or coming as far as back to the previous high, but not closing past the previous high, coming back to the previous high, and then continuing to go down. We're gonna see this. So in this particular case, again, we had an upward structure, price going up. We got a high, a lower high, a higher high, and then price started to push back, which we didn't know whether it was just a pullback to continue up. But once it broke the structure of the swing low, let's say, we have a swing high, swing low, swing high, swing low. Boom, it broke the low. Then it pulled back and then pushed further. Well, once we see it break structure, break this swing low, we wait for the pullback and then reversal. That's the most ideal time to get in. You know, if you're a conservative trader, which, as you can see, takes time and patience to wait for. Okay. So that's one thing you'll see price do at times is after reversal, break the structure, pull back, and go. Another scenario that you'll see happen is similar to this structure that we just drew. You'll see price get to a high. It doesn't have a structure nearby to break, but it'll get to its high, its RSI high level. It'll create its own structure. its own swing low. And then it'll break that swing low, say right here, and pull back and then go. So you'll either see price break a swing low right here, or you'll see price create its own swing low, pull back and break it. And that's when you wait for the pullback and go. Because say if there was a swing low that's about, very far away, price to start creating its own downward structure. So let's look at this. When you are leveraging the RSI, you can't just use the RSI all by itself. You have to use some other analysis. And in this case, what we're looking at is we're looking at price action, and we're looking at structure, and we also looking at support and resistance to factor in what to do here. Now let's step through giving this quick little lesson on what to look for if you are a conservative trader. Mind you, you may be asking, well, if I was an aggressive trader? The aggressive trader will simply see this reversal pattern and enter the trade for the sell. They understand that they are at an overbought area on the RSI. They waited for the reversal signal and they just went in for the sell. In either case, you want to use good risk management and always consider your risk to reward ratio. We'll get into that as we step through here. Okay, so now we have the reversal signal, which is a bearish engulfing bar pattern. And if we were going to leverage one of these strategies of waiting for price to break support, pull back, and then give us a reversal signal to continue in the direction of trade, what that would look like is first, we would have to identify some level of support. So if this is all we can see, what is it that we see on this chart right now and nothing from the past? We would look at where price is at right now, and we would have to say, all right, where could we consider a swing high, swing low, swing high, swing low? Okay, so right here, we see price pushing up. We see some bearish candles, which represent some type of pullback. We have price pushing down here, then we have price pushing up, has some bearish candles, represent price falling a little, and then we have price going up. So wherever you have price pulling back with bearish candles, that's a representation of price, falling to some sort of low before it could possibly push back up. So here, where price is falling, we're going to use green solid lines as support, and we're going to use red solid lines as resistance. So if we looked at this reversal candlestick pattern and see how price pushed down, if we was an aggressive trader, we would have just waited for the reversal pattern, and then we would have sold after this candle closed, and we could have sold down to support. Another level of support, we could see a little red candle on the left. We could have sold down to here, support. Now, as a conservative trader, when we say we want to see price break structure, then that brings us back to this level right here. where we see price coming to this level of support. It's finding support here, kind of breaks below it, and then it pulls back. So as price was pushing down, pushing up, pushing down, pushing up, now it has broken some lows, and then it pulled back. Okay, so it broke swing low and then pulled back. And after it pulled back, we look for an opportunity for a reversal. Now, in this particular case, depending on your level of understanding and clarity, you have to understand candlestick patterns. Right here, when price pulled back, it was pulling back. We didn't know how far it would pull back. You know, it was pulling back right here. We just know that we broke some swing lows, and now we're getting a series of bullish candles. We don't know how high it's going to go, but we would have been tracking. Now, in this particular case, as we were tracking, we could have do what I call track price, in which I'm going to use two white lines, two horizontal white lines. So we have bullish candles, and then we're essentially moving up. And what I'm looking at is this candle right here. Now, if you look at that candle, we eventually got a bearish candle. And that bearish candle stayed within that range. Then we got a second bearish candle, which also stays in that range. So we know price is starting to lose its momentum to the upside, and perhaps the bears are looking to take over. We had price pushing up, meaning the buyers were, in control of the market. Now we have the sellers coming into the market. And before, the buyers pushed price up as high as this level. And we know we were at a RSI high, and price fell, and now the buyers came in, wouldn't let price go down lower than it was before, and now price is pushing up to as high as it could get. And now we have sellers coming into the market. Now, what we want to see is we want to see the sellers' momentum engulf the buyers' momentum. So right here, where we have price close below this candle right here, that's when the sellers essentially took over. That's when we really had the reversal pattern. This is a golfing pattern of this candle, meaning that the sellers have taken over. Okay. So at that point, that would be a good opportunity to now come into the market. So in this particular case, we would have looked to sell to a swing low. Now, what I always tell traders to do is to ask yourself, is the fox worth the chase?
Maybe, maybe not. 50-50.
What does that mean? That means, is it worth the risk if I was to trade at this level based on what I can see and go after profits, considering my risk to reward ratio? When you are considering entering a trade, you always want to consider your risk to reward ratio, and you want to use proper risk management. So we're going to clean up these charts a little. And we're going to look at a concept of good risk to reward ratio, good proper risk management, and asking ourselves, is the fox worth the chase? Okay, so we're going to put our levels of support back on the chart. We're going to put a level of resistance. Now, resistance, you can consider resistance at the wick or at the body of the candle. This is support. You could consider at the body or the wick of the candle. Okay. So just keep that in mind. It's just an area. So in this case, we were looking at price, pull back, and then we have price engulfing this candle. Let's highlight this area. With a white box. So we're honing in on this area right here, where that candle broke outside of that area to the downside, in which we are considering price to now be trending down. And this is the start of our swing high, swing low area, swing high, possibly get into a swing low. But we can't predict the future, but that's just our bias. So now we're considering taking a sell trade. And as far as what we can see, we're seeing that we have a level right here for a swing low. Now we're going to consider this as a TP, let's say a take profit. If we consider this as our take profit level, then what we want to do is measure from this level to that level, which gives us somewhere around 17 pips for this particular entry and trade. Now, 17 pips may not seem like a lot to some. 17 pips might be great for others. But it's not really the number of pips that matter. If you understand risk to reward ratio, proper risk management, no matter what, you're trying to get a trade that's favorable in your direction and for you to reach your take profit. It doesn't matter if you were going after 17 pips, 70 pips. Your risk can be 1 to 3%, depending on your skill level, 1 to 3% per trade. That means that your stop loss, whatever you choose as your stop loss, and we will get into that, will always just be 1 to 3% of your trade, while your take profit could be 2, 3, 4, 5% of reward. So you're risking 1 to 3%, and your reward is 2 to 3 times more than what you're risking. So let's see what I mean by that. So if you can see that your swing low was 17 pips away or 170 points away, depending on who's counting, you will have to measure back to where would you consider placing your stop loss. A key level, key area is always a previous swing high. If you're taking a sell, a previous swing high, a previous high would be a good area, because if price is going to continue to respect the downward structure movement, your next swing high should be lower than your previous swing high. So if you measure back and see that your previous swing high is 22 to 23 pips or so, and your swing low, your previous swing low is about 17 pips, then you're upside down. That means you will be risking 21 pips to get 17 pips.
I'm beginning to think that was a bad idea.
That's really dumb. That's really dumb.
That doesn't add up. That's not good, trading or financial sense. So you want to be willing to risk 1% to get 1%, or 1% to get 2%, 3%, 4%. That would be upside down. So you have a couple of options if you were considering to take this trade. What you would do is either one, you could consider a further take profit. You're considering this to be a downward structure, then you would expect for your next swing low to go even lower than this swing low. Okay. Or you could bring in your stop loss some so that you can get your 1-to-1. Make your stop loss 17 pips away. And you could possibly not get stopped out and get your 17 pips. You can consider leveraging your Fibonacci to see how far price can go. That's a whole nother lesson. We have a video for that. You can see price push down, pulled up, and you can leverage your Fibonacci to see how far price can go and get your profits there. So there are different things you can consider when taking that trade. You could decide not to take the trade at all and wait for another setup. The other option is to wait for price to pull back, if it does, to an even more favorable position. Right now, price is right here. Let me put my support level back. Right now, price is right here. And we're looking at price to get down here. So we have price breaking out. We already had a breaker structure. We had price pullback. We had reversal pattern, and we're looking for TP right here. So we could wait for price to pull back further because we know that this is a level of support. So maybe we can get price to pull back further to get a better entry. And we got price back into this area of resistance. Then we could look into how, if we had an entry somewhere up here, instead of looking at 17 pips, we're now looking at 27 pips. And our stop loss is now 16, 17 pips. So by asking ourselves, is the fox worth the chase? At this particular level, when price broke out and confirmed a reversal at this level, the answer would be no. Taking the trade right here was not really favorable without stop loss above the swing high. We would be risking more than we will be willing to gain. The best scenario out of all the ones mentioned would be waiting for price to pull back, see if we could get a pullback at this support level, and then we would have a better entry. We don't know how far price is going back, and if it will go back or not. But if we practice patience, it's possible that it can happen. If it doesn't, we just got to wait for a new setup. So when price pulled back to this area and still showed some sort of resistance, this would have been a good area to consider placing a sell. Therefore, we would have been risking about 16 to 17 pips, of loss to be stopped out to gain about 25 pips in profit. That's more favorable. We're gaining more than we would be willing to lose. Okay. So let's continue through here. That's where we would have took that trade based on those conditions. And as we can see, at some point in time, we reached our TP. From there, price pulled back. And this is where, when you come to the charts, you look at the market, if you were able to mark up your charts and see what did price do, where are we at now in the market, which you could have done, now you can make a decision. Okay, you can see if you went back a little and identified we were at an overbought area, we got a reversal signal, a bearish engulfing bar pattern, price pushed down. If you was an aggressive buyer, you could have sold there to the next level of support. Price then pulled back for the conservative buyers and gave us a continuation to the downside signal. From there, we identified that that wasn't the best place to place the trade as far as risk to reward is concerned. So if we waited to price to pull back, a more favorable area to still go for the same take profit scenario, then we could have sold and reached take profit without risking as much as we would if we would have entered down here. Now, in this particular case, we got a pin bar. Pin bar is a reversal candlestick pattern all by itself. Ideally, when pin bars are presented or printed at the very bottom of a downtrend or at the very top of an uptrend, that's a great, great signal by itself for a reversal. Here, we can see that we have a downward structure. We were at a swing low, swing high. Now we're back around the swing low area. We're not really at a low, a lower low. We're just at the swing low area. And this does still signal some type of reversal. And as we can see, price pushed up. Now, again, if you remember we said earlier, we want to see price breaking structure to consider a real reversal. This case, price just pushed back up. And if it didn't break structure, what we mean by that is if we look at the swing highs and swing lows, or if we look at support and resistance, we would say at this particular point in time, this would be our swing high, which is an area of resistance. This also could serve as an area of resistance. So what you will want to do is you want to mark that area. We're going to mark resistance with a red line. Okay, so we want to see if that area get broken, that level get broken as far as resistance. So price pushed up, which right now, if we're considering price is pushing down overall in a downward trend, price would just be having a little minor pullback. And so long as price don't reach this level, and even more so this swing high area right here, then we are still okay. Price is having a little pullback. And once it pulled back, we want to look for a reversal. One of the greatest candlestick bar patterns that you got to be studying and mindful of is the inside bar pattern. It happens often. People don't recognize it, and it's really consistent. Also you have the evening star patterns and the morning star patterns, which is pretty much similar. Well, here we have this bullish candlestick, and we have this sort of like doji, and this is a candle which falls within the range of this bullish candlestick. hence inside bar. And price right now is staying in the range of this bullish candlestick until it either close above this bullish bar or close below this bullish bar. So as price is pulling back with the reversal signal of this pin bar, not breaking this high, we get a continuation or a reversal signal right here with price closing below. The signal that we're still continuing to push down. Now at that point, that's where the aggressive buyers could get back into the trade to continue to sell. But if we look to the left, we don't know where we can sell down to if this is all that we had to go by, which is, as a conservative trader, we can see that this was a level of support. This level of support has now been broken, even though we got a reversal pattern. Price is reversing. It now broke this support. And now we wait for the pullback. And now, because we waited for the pullback, we can now look and see that when we're right here, we can look and see where we can trade down to. Like price could have pulled all the way back up here. We now have a new low that we could trade down to. That's why it pays to be patient. So price broke out here. We don't trade breakouts. I like to say breakouts are the fake outs. We wait for a price to pull back, give us another reversal. So here we have this bullish bar, and we can see price on this candle broke out of that bullish bar, similar to how we drew the same pattern before. If we put our white box around here, you can see how this candle broke out outside of the box. The bearish candle below broke outside of the box right here, broke outside of the box. That's an indication for price pushing back down again. And as you know, a trader, you can trade down to this low. So price broke out, pull back, got a reversal, and we could trade back down to this low. So here we would have traded conservatively, and we could have still reached our TP. As far as risk reward, we would have had to measure out. And again, ask, is the fox worth the chase? So here, if we would have looked at where price broke outside the box, if we traded right here, then we would have seen that we had about 13, 14 pips. And our swing high right here is, again, 17, which would have been upside down. Similar to before, waiting for price to pull back where this bullish candle is, we would have been 10 pips to about 19 pips more favorable. What you can look for is what I call my resistance zone. Some may call it an order block. But here, if you look at this bullish candle, if you look at this bullish candle, this bullish candle right here, if you look at the bullish candle, you'll see that it's followed by 3 bearish candles. You can actually leverage this and create a zone, because that shows you that that's where the sellers came in and pushed the market down. Same thing over here. You have this bullish candle right here, followed by 3 bearish candles. And you have the same thing right here, bullish candle followed by 3 bearish candles. And the reason why I'm pointing this out is because let's use a different color for my arrow. Right here, when price broke out and gave us a bearish signal that we were reversing, price came back, and you can now leverage the low of this bullish candle as where you can wait for price to get back to sell down to that TP level that you were looking for, as opposed to trading a breakout, which we don't recommend doing. We rather wait for price to retrace. So price broke out, it retraced to our resistance level, and now that would have been an opportunity to get into the sell. Okay. Wait for price to break out, return to a resistance level, and then you get into the sell. Here, this particular scenario, we had price breakout, come back to this resistance level, and then we could have got into the sell for this guy right here, to this TP. So right here, price broke out, came back to that resistance zone right there, and that would have been a better entry to trade down to this level of support. Okay. And we would have hit our TP right there.
Unbelievable. I'm still shaking.
So although you may have missed when price actually got to the RSI high level and you got the reversal signal, and you could have took an entry at any one of these levels for the TP, you could now look at where price, let's say, where price was at now. If price, we came in prices right here, we can see what happened in the past and where we're at, and see what direction the market is going, and look for another entry. Wait for a pullback, mark up our charts, wait for a pullback, and then get into the trade at the next best opportune moment. Okay. And you could continue to do so. We now say reached out TP right here. Price is breaking out past this level of support. And at this particular point in time, we looking down and we can see on the RSI, we are at a low, which is now the time, if one had got in a trade right here looking for a sell, this is ultimately between here and here, between here where you're at an RSI low right here is where you could consider exiting had you got in right here. If you got in right here, you could consider exiting right here or right here, along the term. Otherwise your original support levels is where you will want to exit out at. Okay. So you want to trade from a swing high to a swing low. Your RSI high, best case scenario to the RSI low, but you may not always get that. But just being able to identify where you are at in the market is key. And understanding where you can get into a trade once you identify what the market is doing is also important. So you won't have to wait all the way until price get to RSI high or RSI low. Most traders use those levels as entries and exits. But now that we are right here and prices breaking a level of support, and we identify that we are at a swing low, this is where we would take a pause if we weren't in the trade, and we would look for a reversal pattern to see if price is potentially going to go up. If we were already in the trade and we haven't had any confluences to tell us that price is going to reverse and start to go in an upward direction, we would have experienced minor pullbacks along the way, but we would be able to still hold our trade, perhaps move our stop loss down into more profit, and continue to ride the wave. So what would have you to want to exit a trade? Again, we talked about this before. If price was to actually start breaking structure, breaking the previous swing highs in a downward trend, or breaking the swing lows in an upward trend, that's when we will want to consider exit the trade. If you was going to hold on for that long, all while stepping down on our trailing stop or our stop loss if you want to manually do it. So at this particular point, when price is breaking out, we notice that we are at a swing low. We're considering price to either A, have a retracement, a correction, a complete reversal, whatever the case may be. This is where we're looking for that to be, just like we've seen over here. So we will be looking to see if price wants to reverse, have some type of retracement, correction. So we did get a bullish candle, price did pull back, but the time to consider exiting would be when we are actually closing above a previous swing high, or a previous pullback, a previous retracement, a previous high of bullish candles. If price was closing above those previous highs, then we consider price is actually, starting to change direction. So here, price went as high as here and pushed down. Now this area, this level right here, where price went up to and then pushed down, is the same area where price was supported over here. We have price being supported right here. So that could be a good area to see if price is going to respect and be resisted, or ultimately if price is closing above these areas right here, that's where we have level concern. So as we can see, price push back down and went into a consolidation pattern where if we look at our original level where we had our TP, we can see that price kept getting rejection at that level. So this was our support level that price pushed off from. Swing low, it went up. Now here we are receiving rejection, rejection, rejection. So price is rejection and respecting this level. Right here, we got a huge candle, which showing indecision. We don't know if the buyers want to take over or sellers want to take over. It's really confusing. But within this range, depending on what type of trader you are, you're conservative, then what you could have done is, let's say, again, trap price. This time I'm going to use these blue lines, aqua lines, show you what I mean. So we could have trapped price between the top and bottom. Anytime you have a large candle, you could trap price and say you're focusing on this area. Okay. Now you could either wait for price to close above this level or below that level, or you could find another combination of candles to give you a signal. But ultimately, the price closes above this area or below this area, that's letting us know that price is now rising or falling. Because just imagine, if price closed above this area, if you look over here, we're now closing above our swing high. If price is closing below this area, it's closing below a previous swing low-ish level that we had before. So now is really time to be patient. As you can see, price just consolidated. After price fell so much, it went into consolidation, a ranging market. Now, if you waited for that, you can see what the results were. But if you were more advanced and understood candlestick patterns, then right here is where we identify, okay, we have a bullish candle right here, and we could attract price in this candle right here, that bullish candle. And as you can see, we have an inside bar pattern right here, and then price close below it. that tells us that price is looking to continue to push down. And the least we can trade if we want to trade is down back to this low level. So if you got in based on that scenario, again, you could have waited for a pullback and then got in, depending on the risk reward ratio, and then price fell down. So using candlestick patterns at key levels is a high probability that you will be consistent in making good trades using proper risk management. Candlestick patterns, reversals at key levels is what you should look for. Now, let's talk about the difference between this RSI indicator, which is standard and comes with your trading platform, and the optimized Forex Fundamentals Pro RSI indicator. What we've noticed is that the way we step through this probably made sense. If you studied it, practice it, you get to a key level, you wait for a signal, you get your confirmation, then you consider your risk to reward ratio. If the fox is worth the chase, you go ahead and take the trade. Simple as that. You get to a overbought or oversold. We also know that it's not a guarantee of reversal. It may just be a correction and continuation in the direction that price was already going. The problem with the standard RSI is, although the way that we just demonstrated how to properly trade using the RSI at overbought and oversold areas, chances are you may not be there when the RSI gets to those levels.
Exactly.
When the RSI gets to the 70 or the RSI gets to the 30 level, you may not be there. Also, what's happening as price go along, which another reason why people leverage the RSI indicator, is divergence. You would have to be able to identify divergence. Divergence is when price, for example, is falling, but the oscillator itself is not falling, or price in itself is rising and the oscillator is not rising. They're going two completely different directions. So let's see if we can identify divergence. Let's see. I would say, based on me looking at this chart, that we have some divergence. We have a low right here, and we have right here. What I'm looking at is I see on our RSI, we had the RSI 30 or lower, and then right here, we had higher than 30. But if we look at these candles, say right here, this candle and this candle right here, the second candle is lower than the first candle. Well, on the RSI, the second low is higher than the first low. So we got a high low and a low low as far as price, a high low and a low low as far as price. We have a low low and a high low as far as the RSI. So price has fallen lower, but our RSI has not fallen lower. That would be divergence. And divergence is also important when it comes to trading. Identifying divergence is also key to see where a possible reversal will take place. So you probably won't be able to identify that clearly using a standard RSI indicator. Well, with the optimized FFP RSI, divergence and signals indicator, we can actually identify where the RSI is, and we can also identify divergence.
Wow. That's amazing.
So let's look at being able to identify when the RSI reaches 70 and the RSI reaches 30. what we would do is use our FFP RSI divergence indicator, and we would say in the properties section, show arrows for our value cross section. And we would turn it on. And as you can see, down at the bottom when I optimize, we are identifying when the RSI is above the 70 and when a RSI is below the 30. We even have it right here. And these are just not arrows that show you visually. We can also turn on alert so that we can be alerted via our mobile device, via our platform, desktop, laptop device, via email, via sound, via pop-up alert. We will be notified that the RSI reached the 70, the RSI reached the 30, or any number that we set inside our property section. If we wanted to know when the RSI is crossing the 50, above or below the 50, we can change our settings to show us that, and the arrows will adjust accordingly, and the alerts will alert you when that happens. So let's highlight and let's see if we're accurate. Right here where our green arrow is also right there where our blue candle is. Right there where our red arrow is, also at the bottom on that particular candle, as well as right here. So these are all key areas that we could have been notified when the RSI actually get there. So we won't be staring at the charts and wondering, waiting, which could take hours, if not days, depending on what time frame we're looking at, what financial instrument we're looking at for that to happen. Now, we can also identify if there's any divergence. We go down to our divergence section and we can turn on show divergence. And as we can see, we have some divergence over here, which is in a key area, followed by a reversal signal. This is all extra confluence that price could possibly be turning around to reverse. We have divergence. That means that price was rising, but our strength, or our RSIs, the buyers was losing its momentum. Price was rising, but the buyers was not still buying. And then eventually we turned around. So we got to a high point. Here in divergence, that means that the sellers were selling, price was falling, but the sellers start to lose their momentum where we get some divergence. And if it was strong enough, price would start to push back up. Okay. Divergence doesn't necessarily mean a complete reversal. It also, just like when we are at the RSI high or low, the 70 or 30, can indicate price just making a correction. Okay. We have some divergence here and divergence here as well. And we can actually step on over to see what ultimately wound up happening. We have our divergence signals and price push up. So with the optimized RSI divergence signal, you can be alerted when we are at highs and low areas, RSI levels, when we are actually experiencing divergence. So I would highly recommend leveraging our optimized RSI indicator. It will actually give you an edge in the market if you like to leverage the RSI to trade. So we went over how to leverage when price gets to a point where it puts the RSI at an overbought or oversold area, which is around the RSI 70 and the RSI 30. But now with our optimized indicator, we can identify divergence as well, and we can leverage divergence. Let's show you how that is possible. By knowing where divergence exists, what we can do is simply, when we get notified that divergence exists, a simple strategy you could use, we'll step through it fairly quickly, is you see divergence. It's going to mark two highs if it's bearish divergence, looking for price to push down. It's marking two lows if it's bullish divergence, the price looking to push up, potentially. What you can do, so we're going to clean the charts up first. Just so we can specifically look at divergence. Now, right here on the top left, we have some divergence. What you can do is when you receive divergence, you can go down to the swing low. You have bearish divergence, you go down to the swing low. Okay. Now, if price is breaking that swing low, and what I refer to the swing low here is you have two high points that you'll have your divergence bar pointing up. So you want to look at the lowest point between the two high points. The lowest point in between the two high points. We're going to mark that. Okay. So at that point, similar to our previous situation, you want to see price break that level, come back to our resistance zone. Our resistance zone in this case would be us drawing a box around that bullish candle where we see three bearish candles pushing out. Price push back to the surface of that bottom of that bullish candle. That's where we could have a pending order. You have a sell limit order right there to enter the trade automatically for us. We don't even have to be there. So we can leverage that, looking at price that way and leveraging divergence. We also can know that price is trying to push down. It's not guaranteed, but again, we got a reversal signal after divergence in which we could have took the trade. Another opportunity, if we do it, look at it the opposite way, is similar to price pushing down. If we looked at divergence, we got a divergence signal. We put our resistance zone at the top. We want to see price break above and pull back to consider pushing up. Also, similar to after divergence, we got a reversal signal to push down. We could have sold down to our low if it was worth it, or our lowest low if it was worth it. Similar to here, we had a resistance zone instead of a support zone. We have a resistance zone. If we have after divergence, we got a reversal signal to the upside. We could sell to that level if it's farther away and it's worth it. If the fox is worth the chase, we could sell up to that level, not past it. We never want to sell past resistance unless we have proof prior to that price has already went higher there and we are already trending up. But right now we don't have that. We know this resistance is best to trade to just resistance. Okay, but if price broke and closed above it and then came back down and we got a reversal signal to go up to that new high, then we can trade up there. Okay, so you can use the high when you're having bullish divergence as resistance to trade to. If you get a reversal signal confirmation and price is going up, you could trade down to the low of support if it's worth it to trade down to the low. If you got a reversal signal down to the low, in this case, on the left-hand side, I don't believe it was worth it at this point, but at a lower point, it would be. Same case here. Between these two guys, this low and this low, this would be the high. And price, as we could see as price went on, it never made it there again to that high. Prices pull it back and never made it to that high. Here we have another level of resistance between here. No reversal signal to push up there. It just was continuation onto the downside. And one last one or two we'll look at is down here. What we're looking at is we have divergence signal right here. We have this bullish candle. After that candle and after that divergence, what we have is we have price giving us a double bottom type of pattern, which signals a reversal at the bottom of a downtrend, which we can trade up to that resistance. Here we broke out above that resistance level. It's a minor resistance level, and price pulled back. And if we got a reversal signal, we could trade back up. In this particular case, if we were looking at this bullish candle and this bearish candle, that's sort of like a reverse signal. And we have resistance right there. If we marked out our charts properly, we have resistance right there, and there was nothing to do. Price would have to fall back lower. And again, if we marked up our charts to identify a support zone, then what we would do is highlight this red candle that precedes these three or more bullish candles. And in this particular case, we can see that that is where we found our support for price right here. We use this bearish candle, bullish candles pushing up, support zone that price respected, and price pushed up. So this pin bar-ish like signal was our reversal signal at the support zone that we could consider trading, at least back up to this higher high level than the previous level of resistance that we had before. So the previous level of resistance was this blue candle right here when price was going up here, but then it broke up and went higher. And when price came down lower, we could have traded up to the new high, not past it. Price broke out, pulled back, and then we had another reversal signal at this low. The reason why we're looking at buys is because we're at a low and price is starting to push up because we got reversal signals at the low. We got reversal signal, price pushing up. But overall, if we erase these lines and we see the bigger picture, because I never like to trade using just one candle ultimately. The only time I would consider using one candle is we're looking at that pin bar. That pin bar is this pin bar candlestick pattern right here is a reversal signal with itself, especially after being at the bottom of a downtrend. This is a strong signal at the bottom of a downtrend. But if we look at what price did right here, it actually did the other scenario that I spoke about before, where it created its own level of resistance because upon price falling down here, there was no real significant resistance, that was created. So it created this new resistance or found new resistance that respected as sellers came into the market right here. And then it broke past that resistance. And at that point, that's where we would have marked this resistance right about here and waited for price to pull back down, which it came down right here. And then it gave us this reversal signal right here. And then from there, it really was go time. Now, if you was an aggressive trader, you could have took a buy right at this point. But if you're a conservative trader, then even after receiving this, I need another bullish engulfing or pin bar or inside bar that breaks out to the upside pattern is what we would need. And we have it right here. We have it right here. We expand the support zone over. We can see that we have this engulfing bar scenario at the support zone. You have this bearish bar and you have this bullish engulfing bar. This combination at this support level is significant. Price breaking up to the upside, even came back and gave us another chance to retest this support level before price pushed up. So understanding candlestick patterns, understanding support and resistance at key levels will help you go a long way in trading the markets. So leveraging the FFP divergence indicator, you can now have a leg up on when price pushes the RSI to RSI low, RSI high. You can also identify when we are at levels of divergence, and we can trade up to resistance if it was a bullish divergence, trade down to support if it was bearish divergence. If price broke out above those levels, we could definitely consider price pushing up, from there. If price broke below those levels, if it was bearish divergence, we could definitely consider price now pushing down. So hopefully we got a lot of information in this session. Hopefully, if you have any questions, be sure to comment down below. Press that like button, hit subscribe, share. We like to say sharing is caring. Give us a thumbs up if you like this. Give us a thumbs down if you didn't. Either which way, we here to help and educate and help make it user friendly. So if you would like a copy of our RSI optimized indicator, be sure to check the link in the description below. And until next time, happy trading, and we see you in the next one. Bye for now.